I'm going to talk a little bit about an overview of the covered bond market today and how it got there. Talk a little bit about the definition of actually what a covered bond is, something that Boris just spoke about very briefly earlier. And I think more importantly, in a new country that's coming to the market for the first time, look at some of the possible objections to covered bonds, some of the things that can go wrong, some of the things that people might not like. And then finally, I'll speak about some of the hot topics in the covered bond market that we're talking about today that are going to come up in some of the other speeches that we hear today. After that, I'm then going to hand over to the EBRD, to Jacek and Andrea, to talk a little bit about what the EBRD does in the covered bond market in more detail than Pierre went to. So first of all, let's just talk about the size of the covered bond market. I think the first thing is it's a very large market, but it could be much larger. We have roughly 2.5 trillion euros of covered bonds outstanding. Now, not all of them are backed by residential mortgages. Not all of them are in Europe. Roughly speaking, we have about 2 trillion of mortgages funded through the covered bond market in Europe at the moment. If you compare that to the total market stock of about 7 trillion, yeah, roughly 30% of all houses in Europe are funded through the covered bond market. When you think of deposits, central bank money, LTRO, all of the other sources of banking, 30% is really quite a high number. One comparison that I like to make is it's very similar to the share that Fannie Mae and Freddie Mac have in America of the American residential mortgage market. Now that 30% though, that covers literally, because a very, very wide range, literally 0 to 100. In Denmark, every single mortgage is funded through a covered bond. And in many countries, including obviously here, we don't have any covered bonds outstanding at all. A lot of people spend a lot of time talking about Germany in this market for very good reasons. But actually, the German percentage of German houses that are funded through the covered bond market is roughly the average. It's a little bit below 30%. There are other reasons why Germany is so important when we talk about covered bonds, and I'll come on to some of those. Just to apply those numbers to Croatia, there are about 7 billion residential mortgages outstanding in Croatia at the moment. So simple maths, if we had the same ratio, we'd have about 2.2 billion of covered bonds outstanding. That's a really dumb way to calculate it. It's a very simplistic way to calculate it. More importantly, that 7 billion euros represents, I've noted it down, about 15% of GDP. On a European average, that's quite low. The average across the whole of Europe is about 45 to 50% of GDP, is the size of the residential mortgage market. So you're about a third of the average relative to GDP. And of course, GDP is below the European Union average. And so if you translate it into per capita terms, the average Croatian has about 2,000 euros of mortgage debt. The average European has about 16,000. So the potential growth of the market, doing the maths, is about an 8 times potential increase, which works out at about 50 billion of new funding. Now, of course, we're not going to converge tomorrow with the same GDP, with the same mortgage to GDP ratio. But if you were, that would be about a 50 billion euro funding gap. I said that this could be a much larger market. I put this graph, not because the numbers are particularly relevant, there's one interesting thing. The covered bond market overall grew until about 2012. It grew through the financial crisis. It grew through all of the bad years up until then, and then it shrunk slightly, more or less plateaued. It stopped growing despite the cost savings, despite new countries coming online, starting to issue covered bonds for the first time, like Canada, like Singapore, like Australia. Why is that? Well, I think that there are a few contributing factors, one of which obviously is the huge amounts of liquidity in the system. Boris previously spoke about the structural liquidity surplus here. It's a structural liquidity surplus in a lot of countries with the amount of money that comes from central banks into the market. When we'll see a normalization of that and a reduction of an amortization of the TLTROs of the ECB, then presumably there'll be more of an onus on market funding, and presumably the covered bond market can approximate to its normal run rate. The other point is, actually, we've seen extremely low mortgage growth in most of Europe. About 1% year on year for the last 5 years. Now, that's slightly below average growth rates, significantly below average or total mortgage size. In Germany, the UK, Sweden, several large economies, the mortgage market is growing very significantly. So the house prices are growing very significantly, but mortgage markets aren't growing as quickly. If there was a catch-up in terms of the amount of mortgages funded, we'd see a very significant increase in the number of covered bonds outstanding. So I think that's all I'd like to say about the market as it stands at the moment. And of course, you know, can quote numbers about the total new funding need. It's suffice to say that there's a lot of potential use of this product in the medium term. I love history, but I don't want to bore you too much with it. I only want to touch on some things which I think are relevant for the covered bond market. Now, the first date up here, 1769. I have no idea whether it's true, but all of my German friends assure me that Pfandbriefe have existed since 1769. I think that has two important repercussions. The first one is that next year is going to be 250 years, so there's going to be some great parties. More importantly, it's something which I think is very deep in the German psyche. It's, whether it's true or not, it's a myth or it's reality. The fact that people believe that this market has been around for 250 years really makes people very conservative about it, very protective of it, very wanting sometimes to be parochial about it, to close the doors to newcomers, sometimes wanting to export it, but say, don't mess around with these concepts, do it like we do it, don't try to be different about it. I think whenever you speak to the protectors of the Pfandbrief, the German covered bond market, they're very conscious of this history, and you've got to be very aware of it. Another important point, a defining thing for the covered bond market was the mid-90s, when Germany had huge funding needs. You know, we're so used to Germany being an exporter of capital for the last 15 years. We forget in the 90s it was a massive importer of capital to fund reunification. One of the most effective tools that Germany had to bring foreign money into Deutschmarks was the Pfandbrief market. It grew to slightly over $1 trillion outstanding at around 2002, 2003. A lot of this was on the idea of what we call the jumbo covered bond. A jumbo covered bond has various definitions, but basically means it's a very big covered bond that we promise is going to be liquid in secondary trading. That was really important to position it as a rival to government bonds in many ways. It was a great, when 1995, when they came up with the idea of market-making commitments, I'll always be able to sell the bond with this bid-ask spread. It sounds a bit crazy, really, nowadays with what we've seen since. But it's an incredibly powerful selling tool to people in the past would have just bought German government bonds. That was a real fillip to the development of the market in other countries. The other one is 2003, when we first saw the first contract law covered bonds. Now, up until 2003, every single covered bond had been a law was passed by Parliament, and then we'd go ahead with that. In the UK, because of English law, which is quite flexible in many ways, and because of securitization technology, which achieves all the things that in other countries you need a law to do, we were able, actually worked on the structuring of this deal, we were able to create something that looked, smelt, felt like a covered bond, purely using contract law. Now, that's not possible in most countries, but what it did is it really gave a good kick to those countries that thought, we need a covered bond law. There are lots of banks were clamoring in a lot of countries, in Spain, in Portugal, in Finland, in Holland, in Italy, we're all saying we need something like the Pfandbrief system. And hey, the Brits have just done it under contract law. And in all of those countries, they had a very busy few years working with governments in all of those countries, bringing online covered bond laws to try to replicate this in many ways. And this is where we went from 3 or 4 large countries to 20 countries issuing covered bonds. And then the final thing, and it's something that we're going to talk about a little bit, which is this year, very hot topic at the moment, is the directive. For the first time ever, there's a covered bond directive, and I think many speakers will talk about that today. Florian and myself will have a chat about it later. Why does history matter? Well, as I say, there's some significant points here. The conservatism I've already mentioned, how ingrained it is in the financial system is very important to how you structure a covered bond. Does the regulator know, understand, have a department full of people who can stress test covered bonds, or are they learning from scratch? How does it interact with other financing tools? Is it a complement to securitization or is it a rival? And I think the other thing, is an important one, is success creates challenges. This is quite rightly perceived as an incredibly successful financing tool, which has worked really well for many years in many countries. Therefore, why don't we use it in other things, more risky things? Other asset classes are going to be included as part of the directive. Using covered bond technology to fund loans to small and medium-sized enterprises, maybe to fund green loans, maybe to fund infrastructure projects. That's a challenge to that conservative mindset, but it's one I think we need to take up because of the effectiveness of this tool. And also, new countries. Possibly this year, possibly next year, we're going to see the first Brazilian covered bond. Now, that's a really radical step for such a conservative market that is so used to AAA or at worst AA rated bonds most of the time. To start going outside Europe into emerging markets like Brazil, it's a bit of a shock to a very established system. Now, I've said all this without actually saying what a covered bond is, a fairly fundamental thing, which I guess I ought to mention. Boris earlier briefly mentioned this idea that it's like a securitization with recourse. There's a little bit more to that, but that's a good starting point. It is a dual recourse instrument. In all of the definition, you can just do it with how it differs from securitization. So I think the first point is it has to be issued by a bank. Securitizations are usually issued by banks, but can be issued by leasing companies, by finance companies, by corporates even, if they have assets that you think you can turn into a bond. Here, it must be issued by a bank for one very important reason, that you have this supervisory oversight, actually the third box here. You have a dedicated law, you have a dedicated supervisory regime. That regime must exist to protect the interests of covered bondholders. It doesn't guarantee the covered bonds, but it guarantees that somebody in the public sector has gone, has looked at it, has stress tested the pool, has made sure that it complies with the law, has made sure that it's as safe as it can be within the context of the covered bond law and what the regulations allow. I think that's an important point that is often forgotten in covered bonds. The other point is, yes, it's backed by a pool of assets, just like securitizations, but a very important difference is in a securitization, you have a static pool of assets, what I call a fire and forget pool. Here's my assets, I put them in this pool, and if they don't work, that's your problem, bondholder, not my problem. By nature of this being full recourse, it's a full recourse to the bank. There's no point in that. There's no risk transfer going on to the bondholders, so I have to keep the pool current. If something goes wrong in the pool, if this mortgage defaults, this mortgage goes into arrears, typically I replace it. And one of the very interesting case studies of this market, and it's an illustration of how well it's worked, is when you look at covered bonds in countries like Greece or Ireland, which have had obviously massive problems with their residential mortgage markets. In those countries, the cover pools looked absolutely fantastic through the crisis because of this constant replenishment of the bad with the good. It's a very important thing which has kept cover bond ratings incredibly stable and has prevented any defaults through the crisis. So when you have all of those things, what's the outcome? It is a covered bond. Now, I know Jacek always loves this one. Securitizations are in many ways a technique that can be applied to all kinds of different things in many different ways. Cover bonds are a brand. What you have here is a distinct thing, a legally protected title, a guarantee of quality, quite frankly. And when you get into the EU directives, it's a lower risk weighting, it has higher eligibility for liquidity pools, it has all kinds of very nice features as a consequence of this brand and this protection. So that is what we're trying to do here. I'm not going to spend very long on this slide because it's frankly not very important. There are many different ways across Europe to structure covered bonds. You can put them into a special bank that only does cover bondy things and is owned by a real bank. You can segregate a pool of assets on the balance sheet of a bank, or you can shift a pool of assets into a separate SPV that writes a guarantee of the bond. Now, that looks like fairly fundamental differences, but in reality, it only matters to cover bond nerds like me and lawyers and rating agencies. Investors generally are indifferent. If they get a AAA rating, I don't care about the boxes and arrows too much. There's no real difference in the amount of rating uplift that you can achieve. You can achieve AAA. There are AAA examples in all three of these models. It doesn't really influence the spread of the bonds very much. It matters to minute legal details. Now, we use these different structures in different countries. Every country has a different set of starting points, set of conditions that we need to work with. We don't just randomly pick one of these. It isn't usually isn't an arbitrary decision. There are important things like, are there negative pledge clauses in existing documentation? Is it legally possible to create ring fencing on balance sheet? Is it commercially viable to set up special banks? Those kind of starting points. But when we've addressed those, you don't really need to worry about it as an issuer or as an investor too much. Happy to discuss it, but yeah, I want to play down the importance of that, to be honest. More importantly, let's just talk about some of the things that I've heard that have said, we don't want covered bonds because. One of the most common ones is, if you've ever seen the film The Big Short, it's about the worst excesses of the US subprime and taking those mortgages and turning them into bonds. Very irresponsible lending, origination purely to distribute mortgages. I'm not going to hold the risk, I'm going to pass it on to bondholders all the way through the capital spectrum. So I'm going to produce any old rubbish. It's a very valid concern about the securitization market. It's one that the securitization directive has addressed very well under EU law. It's not valid in covered bonds because of this risk retention, because of this dual recourse. Because of that, and also because of the very high level of transparency you have. The covered bond market has a reasonable level of transparency mandated by law, by the European Union directive, but in practice in the market it has much more. We have something called the covered bond label, which most issuers sign up to, and they have incredibly detailed templates of what's in the pool in a very user-friendly format. That stops these kind of the bad stuff getting in there, or if it gets in there, investors will know about it. And then the supervisory process. As I mentioned, the individual day-to-day supervision of the pool does a lot to protect this kind of irresponsible lending. Does it encourage more lending? There's possibly more validity to this. If you look at the growth of the Spanish mortgage market from 2004 to 2007, 2008, a very large amount of that was funded by covered bonds. Now, I'm going to defend covered bonds and say it wasn't covered bonds' fault. The correct way to rein in excessive mortgage growth is Pillar 2 capital, general supervisory tools, better pricing of the risk, not by stopping people from accessing a very effective term funding tool for it. And I think the other important thing, and so I don't want to slag off securitization because securitization is very important, securitization has been used as a way to circumvent some of those risk management tools. It's a way of reducing the regulatory capital usage of residential mortgages. We don't do that in covered bonds. Then on the more sort of important stuff, like the consumer rights, it's very important when you're structuring a covered bond that the individual borrower is in no way prejudiced from an issuer's decision to put them into the program. On a practical level, the person managing the program, making a decision about whether I'm going to give forbearance when they're in arrears, offering them new products, it doesn't know whether the mortgage is in the pool or not in the pool. They're just sitting there in the bank, operating as normal. The fact that the mortgage is in the pool or not is something which happens behind the scenes in the IT platform with a little flag saying it's in the pool, it isn't in the pool. The general way that the customer is treated should be identical. It's very important that you address all of these things like the banking secrecy, privity of contract, rights to reasonable forbearance when you're structuring the rules and the regulations to make sure, just from an equitable point of view, there's no bad consequences from being included in the pool. it costs the government revenue. So quite often you have to transfer mortgages, and you get notaries saying, hang on a second, you used to pay me when you transfer mortgages, and you're suddenly transferring 10,000 and not having any revenue coming in. Same objection to the land registry. In all cases when we're trying to structure a covered bond, we're not trying to avoid any of these things, we're not trying to incur any, we're trying to be completely neutral for any kind of costs like this. The transfer of 10,000 mortgages into a cover pool wouldn't happen if it wasn't for the covered bond. In many ways, it's a legal transfer only. It's not actually any substantial thing. The mortgages are going to come back when the bond matures. It's purely a legal way of ring fencing. We don't want to incur any costs, and we don't want to avoid any costs by doing it. We just want a neutral. And the same for tax. We don't want anything other than the reality that this is a regular bond issued by a bank, and we don't want to incur any new tax. One of the objections that I've heard in some countries is covered bonds compete with government bonds. Typically, they're very well rated. Typically, they're very liquid. In many countries in Europe, Spain, Italy, Portugal, they actually trade at a tighter spread than the government bond. I think it's a valid concern. It's more of a problem if you're issuing in a domestic currency than in the Eurozone. It's more of a problem for for governments with high borrowing requirements and lower credit ratings where this is valid. But it's an objection which has to be discussed and mentioned as part of the discussion. Does it increase the connectivity between banks, the riskiness between banks? I think it's a challenge. I buy your bonds, you buy my bonds, we have a greater connection. It's less of a problem than banks buying each other's capital, obviously. But it's a valid point. I think it applies much more, again, if you have a domestic market, if you don't have such a developed non-bank investor base. And frankly, and I know Boris has left the room, but it depends a lot on the ECB, on the central bank's policy towards taking those bonds as collateral from banks in repo transactions. And then the final point is, does it subordinate other creditors? By virtue of drawing a ring fencing around the bank's best assets, do the other creditors of the bank somehow lose out? Well, yes, frankly, they do a bit. What is the materiality of that compared to the materiality of the benefits? I think Andrea and Jacek in a minute are going to speak a little bit about some of the benefits of covered bonds. They're enormous benefits. The incremental loss given default by virtue of a ring-fenced pool of assets for the covered bond creditors is very, very small relative to the lower probability of default of that bank because they have access to this term funding market. These are objections we've heard in many countries. Some of them are very valid, some of them have to be discussed. We always like to flush them out early in the process to make sure that we don't have any hidden objections. There are countries where the process is just owned by one ministry or the national bank, and it's very important, and this kind of gathering is great to have this kind of dialogue. What could possibly go wrong with the covered bond market? Well, actually quite a lot of things. There are loads of countries out there where there aren't any covered bonds. Okay? There are loads where there are some covered bonds, but it really doesn't work. Bulgaria is my favourite example. They passed a covered bond law something like 20 years ago. There's 5 million euros outstanding. It basically doesn't work. And an awful lot of effort, an awful lot of political capital has been spent putting a law through Parliament, putting all the regulations in place, and if it doesn't meet the market's needs, or it's too expensive, or it's too onerous, or there's commercial problems, it just doesn't happen. And there are several cases around Europe of that. There are countries where there is lots of issuance, but actually the covered bond law isn't very good. And as a consequence of that, and I'm sure Moody's will have something to say on this, if the covered bond law isn't good, you throw more collateral at it. You have a higher over-collateralization ratio. In Spain, they have a 25% over-collateralization ratio, which is the statutory, is the highest in Europe by far, because actually the covered bond law isn't very good there. They can still get to AAA, but only by virtue of very poor collateral efficiency. And another problem is barriers to entry. If you pick the wrong model, and if you don't get the costs right up front, lots of people are going to be excluded from the covered bond market, lots of smaller players, And in a lot of countries, in Australia, for example, for many years, the objection to covered bonds was, it's just for the big banks. It's just for the players who have easy access to funding. And we small banks, we're just going to lose out because we don't have access to this funding tool. So it's very important to make sure that it doesn't distort competition by giving this benefit. There are many reasons. I don't want to go into too much detail about where people have gone wrong. I'll just mention the last one, and I love this Jimi Hendrix quote here. It's very, very easy to copy Germany, frankly. German covered bond market is the first amongst equals. It's fantastic. It works very well. It works very well in Germany. In Germany, it's been part of the architecture, as I mentioned earlier, for a very long time. Everyone understands it. Everyone knows it. You have very long fixed rate mortgages. You have very clear mortgage lending value rather than market value as the basis of valuations. Many things which don't apply in other countries, but that doesn't stop other countries trying to copy them. My favourite example of this was in Romania, when we were trying to put in place the secondary regulations. There was a comment that for valuation purposes, we have to use the mortgage lending value because that's what they use in Germany, and Germany's got the best covered bond law. And all the banks said, there's no concept of mortgage lending value in this country. All we have is market value. So if we were going to do this, we'd have to go back to every single mortgage, invent a concept of mortgage lending value, and revalue every single mortgage on that basis. That's a deal killer for us. And eventually we said, well, no, just because Germany does it doesn't mean it's necessarily the right thing to do outside Germany. I'm going to very, very briefly talk about this. Some of the things that we talk about in covered bond land. New asset classes. I mentioned earlier the idea of this tool works so well, let's use it to do other things outside the tradition. The covered bond directive we're going to be mentioning earlier. Green bonds. Whenever you go to this kind of event, you have to talk about the opportunities to improve climate measures, all of those kind of things. There is a sector of green covered bonds. It's not a very large sector, but yeah, it's an interesting development. And as I say, the new countries, which you can basically break down into the, let's say, I guess you could call it the Anglosphere, those countries with very nice ratings, who have basically an English legal system, Singapore, Canada, Australia, New Zealand, who have copied our models. Those countries that are outside Europe and not investment grade, we're going to see the first Malaysian covered bond. Not sure if Malaysia's investment grade. We're going to see the first Brazilian covered bond very soon. And as my final comment, the Central and Eastern Europe. And that is a topic that I'm going to leave to the next speakers, to Jacek and Andrea. Thank you.